Sabharwal joins us. It's really, look at the Nifty, 21,410. Sandeep, rarely...
Nifty futures, 21,300 plus.
These are real numbers, guys. These are real numbers. That's the market. When markets, they rally, they can really... the brute force of liquidity sometimes and momentum sometimes can really make the market look stretched. But that's how markets move. Similarly, when they fall, the fall is just going to be very nasty. So please bear that in mind. Sandeep, first, is it getting too good to be true, or we need to perhaps not get, and we should not get carried away with the momentum? What is your understanding of the market right now?
It depends, Nikunj, on the time horizon of the investors. So if it's a very long term, then it's fine. It doesn't matter. But I think when markets move up so rapidly in such a short period, in every bullish phase, we have seen that markets can correct 4 to 7% at any point of time without any reason. So any investor who's getting in today needs to be ready for that. And sudden, swift corrections lasting couple of weeks can come up anytime. Markets can never go up in a straight line. So the investment strategy has to be at this point of time. If you're holding some good stocks, you can keep on holding. If you're holding zero cash, I would say that it's a good strategy to at least have 10-15% cash now, so that you can redeploy as opportunities come up again.
But Sandeep, that's the problem, because you're in the money with pretty much most of your holdings. So where do you book out and take that cash off?
So if you're making profit every year, then it should be easier to sell, right? So I think it depends on what you bought. So my suggestion to most investors at these points of time is that you sell what you bought without knowing why you are buying it. In bull markets, you buy a lot of stocks just because they are going up. But the logic to buy them or the valuation at which they trade is just not there. So I think these are good times to take some profits off those stocks.
And would you be doing the same with the stocks where you've invested? Let's say, for example, if I recall, Vatek Wabag, Titagar, PVR, L&T, would you be looking at, let's say, taking 10% profit across the allocations?
Yeah, so PVR, we are not selling PVR. In fact, we are buying more because that's a stock that has not participated as much. But on the other stocks, I would say yes. Because Titagar, something like Titagar, we bought 7.5% of portfolios in last year at 100 rupees. So then it moved up so much that it became above 20% of portfolio. I don't like stocks 20% plus of portfolios. So we cut it down to 10-12% of the portfolio. And even after that, it's done well. So I think that's how you have to strategize, because even if you're positive on a company so much, you cannot hold it as 20-25% of your.
Interesting. Okay, bunch of other names which are going to be in focus this morning, and you've got BHEL, which has signed an MOU for one of the hydrogen value chain development systems as well. You've got M&M Finance. They're now looking to make a foray into life, health, as well as general insurance. So look out for that stock as well. Since we were on the subject of PVR, there was just a block deal which happened there, and it seems that Plenty Private Group and multiples may sell that 2.33% stake. I don't think the entire block deal has got executed though. Multiple block deals is what we're understanding are supposed to happen on PVR Inox. Also, you've got Hero MotoCorp, which is looking to up its stake in Ather Energy by about 3% to now 39.7% with a 140 crore rupee investment. So these are also stocks which are going to be in focus this morning. But Sandeep, what about some of these contra moves that the market is seeing? For instance, the move in IT yesterday.
Yeah, so IT move has been driven by two things. One, the Fed policy shift, and secondly, there have been some surveys indicating an uptick in IT spending in 2024. So I think both of them at the margin are positive for IT stocks. The challenge for IT stocks is that many people are forgetting that regenerative AI related challenges remain for these software services companies. But that said, they are under at this stage, especially the large cap one. And to that extent, given the way the markets are placed today, the possibility of IT outperforming over the next 2 months is high.
Sandeep, hi, morning. Let's also get in your take then on what the outlook is for some of the NBFCs, because you have the RBI that increased the risk weight impact on NBFCs. What do you believe is likely to be the impact on net interest margins on the back of this move, and how are you just looking at the performance of some of these NBFCs?
Yeah, when the move happened, it was very clear that there will be a NIM impact of 25, 30 basis points at least. But I think the Fed policy change and what it's done to bond yields overall and what's happened to Indian bond yields also actually mitigates some of these challenges. So NBFCs could actually be incremental contribution plays going into next year if uh, the tightening cycle is taking foot and there could be some easing cycle because uh, NBFCs and bulk borrowers tend to be the bigger beneficiaries in any easing cycle than the larger.
One, Sandeep, I've seen multi-baggers. You've seen multi-baggers, but rarely we've seen IPOs become a multi-bagger in less than 1 month. And ladies and gentlemen, I'm talking about IRDA. No prices for pricing the stock. It went public at 32 rupees. Yesterday it closed at 120, which means from the IPO price it is 4x. क्या हो रहा है संदीप?
क्या हो रहा है? I have no idea. Essentially, I think many of these PSU stocks, uh, many stocks have become meme stocks in India. So we have all heard of meme stocks. So a set of HNI investors uh, catches hold of these stocks, liquidity is limited, and then they get pulled up crazily, and then retail investors come in a big way. I think people should be very, very cautious of these moves.
Sandeep, what is the best way to look at, let's say, some of these power finance companies, PFC, REC? They are not trading at price to book of 10, 12 times. They are still trading at price to book, which is 2 times, 2.5 times 1 year forward. I don't know about it, but PFC, REC, their dividend yields are about 3 to 4%. The businesses are looking okay. So we may look at the price change and say, okay, the price run up has been too sharp. But do you think the businesses still have a value? And just hold on, Sandeep, I'm just coming to you. I just want to establish one more point here. Let's look at the 5 year change in some of these stocks, which is what we need to look at, right? I can concentrate and compress the stock in 1 year and then talk about the change. But in last 5 years, Sandeep, these stocks have not really been, they've not really given you multi-bagger returns. They're up 3, 4x.
3-4x in these kind of stocks is very high. They tested the patience of investors for years and then have suddenly broken out. And that's the nature of equity returns. They'll come in 80% of returns come in 10, 20% of that. Now, when we look at a company like PFC, in fact, I was yesterday only studying the valuations, etc. One, it's a single sector exposure, NBFC, so that always is a risk because power in India, despite all the changes, has political risk. Secondly, PFC today trades at valuations which are higher than that of Axis Bank at par, reaching at par with uh, ICICI Bank. So I think people need to decide whether these stocks should trade at these kind of valuations or not, because finally they are NBFCs. So I would think that the rally is overextended at this stage.
Sorry, the rally is not extended. I just missed that last part.
Overextended.
Overextended. Okay. What about defense and railways? Rally extended, extended, not extended?
Yeah, majority of the stocks in railways and defense also have overextended rallies. The difference being that in defense as well as railways, the visibility of order flows is very strong. So we should look at accumulating them as the correction when plays out whenever it plays out.
Sandeep, good to have you on board. Thanks so much for joining in.